Hello friends, now in this video I will be taking static trade-off theory, pecking order theory, target capital, structure, weights and illustration related to approach, then static trade-off theory and then target capital, structure, weights. So very relevant from exam point of view. But before going for this video, it is expected that you are very much clear about without approach theoretical concept and the numerical question what we have already done, as well as the with taxation theoretical concept and the numerical question whatever we have already done, that 6-7 step question. So this video will be in the continuation with that approach only, because static trade-off theory is I can say improvement over the with the taxation theory. Before understanding the static trade-off theory, we should be knowing the formulas and mathematics what we have already done in the with tax approach. So let's take a recap and then we'll go for the numerical illustration. I will be covering numerical illustration again for one more illustration for without tax, with tax. So where is the illustration? Yes, this is the illustration where we will be covering without tax and with tax, again valuation, again cost of equity, again WACC calculation. So earlier we were doing the illustration with the two different companies. One was unlevered and second was levered, and now I am going to change my unlevered company to levered company, and we'll see how the valuation is going to change, how cost of equity is going to change, and what will be the effect on WACC if there are no taxes and if there is a tax rate. So next, then second, we will cover the calculation of target capital structure weights using the comparable company data, and next will be calculation of weight of debt and equity with a very small example of debt and equity ratio is given, and then the last, the important, that is the calculation of or finding the optimum capital structure using the static trade-off theory. So almost everything whatever is there in our study mat I am covering with new illustration, so you can do practice with the study mat illustrations also. So let's start with the today's work. So what we have already done, we have already done first approach, that is propositions without taxes. Propositions without taxes. So what is the problem we were having in the approach? There were no problem, but there were certain assumptions, and these assumptions became limitation. Even in when I was teaching this approach also, that point of time I have covered these assumptions in very detail, and during that also we understood that there are two assumptions which will be improvised in the next approaches. That is the first approach, that is without taxes, is having the assumption that there are no taxes, income taxes, and number two, there are no bankruptcy cost. So themselves improvise the taxation limitation, but that bankruptcy cost will be improvised in static trade-off theory. So let's start with the brief recap of this approach. So now first, before going for this, what we are trying to do in this study mat, what we are trying to find out, what is the objective of studying capital structure from the company or the firm's point of view. We want to find out, what we want to find out is what is the best capital structure for the company. When I say best or optimum capital structure, the optimum capital structure should maximize the valuation, wealth of the company as well as the shareholders. So that is the objective. So any capital structure level, any debt equity combination which is going to maximize the overall value of the firm and the value of equity shareholder, that will be treated as the best or the optimum capital structure. That is the objective of studying all these theorems. So first theory, when we were doing approach without taxation, this theory says this is a irrelevant decision. Capital structure is not going to impact your valuation of firm. So if it is not going to impact valuation of firm, you cannot maximize your value of firm by changing the debt equity combination. So you need not to worry about the capital structure. This is the first theory, that is proposition without taxes. And there were certain assumptions: homogeneous expectation, unlimited buying, borrowing, lending at risk-free rate, then perfect capital market, information efficiency, no taxation, no bankruptcy cost. Now we are going to study bankruptcy cost. What is bankruptcy cost? Cost of financial distress. And independent decision, there is no impact of financing over the investment decision. It means the cash flows generated by project are independent of the source of financing, or source of financing is not going to place any constraint on your investment decisions. So there were certain limitations, there were certain assumptions which will become, which are actually limitation or criticism also. So first theorem, without tax, which says that two proposition: number one is related to your valuation of the firm, and second and the WACC, and the second is related to cost of equity. The first proposition says that by changing the debt equity structure, if there are no taxes, no bankruptcy cost, no taxes, no bankruptcy cost, the change in capital structure is not going to affect your overall value of the firm. Value of levered will be always equals to value of unlevered. They use a phrase, sum of parts must be equals to whole. Using a pie example, a pie is of, let's say, is of, it represents 100%. If you split half it, 50-50, combine it, again 100, 60-40, combine it, again 100%. So they are saying, but just by changing the capital structure, capital employed structure, this is not going to increase the size of the pie. The size of the pie is dependent on, that means the valuation of the company is 100% dependent on the cash flow, what this the assets of the firm are going to generate. So value of firm is solely determined by the expected future cash flow. Next, and the WACC is not going to change. Why WACC is not going to change? The justification is coming in the proposition 2. Proposition 2 says that as you increase debt equity ratio in your capital structure, the equity shareholder will feel more risk, more uncertainty, because of the presence of DFL, degree of financial leverage. Of course, when you are introducing debt, there is a cheaper source of finance which you are using. So your WACC should come down because of that. But this equity shareholder, this person, equity holder, is feeling more risk, and for more risk, he is going to expect more. And the expectation what he is going to increase will be exactly that much, that the benefit of lower cost debt will be offset by that higher expectation, exactly offset. And from this we have derived a linear equation relationship, that the cost of equity, RE, is equals to your RO plus RO minus RD multiplied by debt equity ratio. So this we have already covered. Next is second part, that is where they improvised the assumption of taxation, which says that if there are taxation involved, this involvement of taxation, introduction of taxation, is going to now change the first theorem. The first theorem was capital irrelevance theorem. Now this is saying that this second theorem says that as you increase the debt in the capital structure, again there are two propositions, one is related to valuation and the second is related to your cost of equity. Now this says that valuation, as you increase the debt in your capital structure, the debt we are going to pay interest, and interest is generally chargeable expense under the Income Tax Act almost in every jurisdiction in the across the world. So if it is a chargeable expense, it means it will be deducted before calculation of tax. So the company which is having more debt compared to the company which is having less debt or unlevered company, it is going to have an additional expense in the income statement. And this additional income will reduce the profit before tax, which will generate an additional benefit in the form of tax shield on interest. And this tax shield will come throughout the life of the company, which is perpetual life. The companies are having perpetual life. So what you should be doing is you should be adding up the present value of all the tax shield while calculating the valuation of the firm. What is the valuation steps? 3 steps. Find out the future cash flow. Number 2, find the expected rate of return required by the investor. And the third, discount these future cash flows by this expected rate. Your valuation you will arrive at the valuation. So the sum up all these present value, that will be the value of that asset or the project or the firm or the company. So now here since you are getting an additional tax shield, if you discount it, that additional tax shield also, this will add up in the value of the firm. So as you increase the debt in your capital structure, the value of firm will increase by a calculation called T into D, that is tax rate multiply income tax rate, corporate income tax rate multiplied by your value of debt. And even if government increases tax rate, income tax rate, this is also going to add value in the overall value of the firm. So this is the proposition. This says that now the objective for studying these approaches is to find out the optimum capital structure. And under this scenario, as you increase the debt, your value is increasing. So the optimum capital structure is theoretically that level where you are going to use 100% of debt in your capital employed. So that will be the maximum value of the firm which a firm can reach. So this theory, the second theory, says with taxes, assuming there are no bankruptcy cost, the optimum capital structure is the level of 100% of debt theoretically if we can use it. So second approach, the second proposition, what it is saying, that this says that cost of equity, of course, as you increase the debt equity ratio, DFL, financial leverage in your income statement, your equity holders will feel more uncertainty, more risk, because they are the residual, they are going to get the residual, whatever will be left after payment of interest. So their uncertainty will increase. They will start increasing their expectations. So the cost of equity will start rising, but not in the same fashion what it was rising in the without taxes approach, because now equity holder is getting that additional advantage of a tax shield. We have taken a mathematical example here also. So that additional advantage of tax shield is going to equity shareholders, since they are getting additional advantage. So their risk is going to reduce. So their increase in cost of equity will be, that increase will be at a lower pace. That is why your green line, which represent cost of equity with taxes, is a bit lower. I'm taking all these base theories because now we are going to start static trade-off theory, which will be a more improvisation of this theory, with taxation. So here your cost of equity is increasing, but at a slower pace. And your value of firm is increasing already as per proposition 1, with the increase in debt and with the increase in income tax rate also. And the impact on the WACC will be, now you are using cheaper source of debt as you are increasing your debt, you are moving on the x-axis. So this is going to create an advantage in terms of WACC. And over and above that cheaper source, that source is also tax deductible. That interest is also tax deductible. So in case of calculation of WACC, we will be using after tax cost of debt, that is RD or KD multiplied by 1 minus T, when we are going to multiply it with the weight of debt. So this equity holders cost increase at a lower pace, and in the cost of debt you are getting additional advantage of tax shield. So this is going to bring your WACC down. WACC is going down and value of firm is going up, and WACC will be lowest when you are using if it is a 2-panel graph, WACC is lowest at the point where your value of firm is highest, and this point is 100% of debt. 100% of debt. This is the optimum capital structure as per with the taxation. And we have done a numerical example for this also, where we have taken two companies with both same cash flows, EBIT 18 lakhs, then we have deducted interest in case of levered firm, in case of levered firm A, and then taxes, and then EAT. Then we calculated the 6-step or 7-step formula. First, calculate income statement. Second, calculate overall value of firm. How to calculate overall value of firm? First, calculate value of unlevered. Then go for calculation of levered. Value of unlevered is equals to the perpetual constant cash flow model. So equity investors are going to get 10,80,000 every year till infinite. So discounted means CF upon I, your discounting cash flow divided by your discounting rate. So valuation will be 10,80,000 divided by the cost of equity 18%, and cost of equity your in case of unlevered is equals to its WACC also, because there are no impact of debt. So valuation is 60 lakh. And from when you are going to valuation of levered, you have to add, because value of levered will be equals to value of unlevered plus the present value of that additional tax shield on interest, which is equals to T into D. That derivation also we have done covered in the last video. So adding 0.4 into 54, we got the value of levered also. Now second step done. Third step, find out the value of equity by subtracting the value of debt. Fourth step, calculate the cost of equity. Cost of equity, the formula is RE equals to RO plus, that is WACC of unlevered, plus RO minus RD multiplied by 1 minus T in case of with taxes, and this 1 minus T will not be there in case of without taxes, multiplied by D into T. So this way we have calculated KCE, that is cost of equity, then calculate cost of debt, which is equals to your 10% or 12% in this example, and then calculate WACC, and WACC is going down from 18%, it is moving to 13.23. So this all we have done. Where is the problem here? The problem is they missed a concept of bankruptcy cost. They missed a concept of bankruptcy cost. Now, what is this bankruptcy cost or the cost of financial distress? Let's first understand this. Cost of financial distress, and then we will go for the mathematical calculation also. So, two illustration we will cover before going for target capital structure and pecking order theory. So, what is cost of financial distress first? Cost of financial distress means as you increase debt in the capital structure, during good time there is no issue, but during bad time, recession, there will be always a tension in the mind of the entrepreneur that we have to pay interest, whether there will be sufficient EBIT, earning before interest and tax operating income or not. And because of that, the company may face some difficult situations also. Maybe your lenders, your financiers, your suppliers force you into a liquidation or bankruptcy proceedings. These proceedings is going to create cost for the company, or they may have certain covenants in their agreements to restrict you to do business, or when you will be, if you are not able to pay your liabilities, obligations, they will try to damage your reputation also. So these are all direct and indirect, cash and non-cash costs which a company is going to incur when company is using unnecessary or very high debt in its capital structure, I'll say. What is cost of financial distress? Financial distress, first find out what is financial distress. Financial distress is it's referred as the heightened uncertainty, the risk, extra risk regarding the company's ability to meet its obligation related to the payment of interest and the maturity amount whenever the debt will be is going to mature. Of course, leverages, operating leverage and financial leverage are going to magnify my returns, but they are also magnifying the losses also. What is the DFL, degree of financial leverage? DFL is percentage change in EPS with respect to percentage change in my EBIT, that is my operating income. So with as you increase the leverage in the capital structure, this DFL is going to increase, and that increase represent increase in risk. Ultimately, during good time, everything is good, but during bad time, this is going to create an extra cost for the company, some negative things for the company, and these negative things can be direct cost and indirect cost. Direct cost are in terms of the cash expenses which company will be required to pay, unnecessary expenses related to bankruptcy proceeding, legal and administrative, to restrict lenders or other suppliers, or your where you have defaulted the in your obligations. You will be required to pay expenses related to court proceedings to save yourself, that means your firm. These are direct cost of financial distress. And second, there are indirect costs also. When you introduce excessive debt, debt holders are going to put extra covenants in their conditions in their agreements. And if you are not going to pay interest or maturity amount on due date, they are going to damage your reputation in the business, in your industry or the business environment. So what are the indirect cost of having excessive debt? That is your foregone business and interest opportunities. They will restrict you to not do some businesses. Negative covenants, reputational risk is always there. Agency cost, an additional cost. What is agency cost? Agency cost is when your agency cost is related to the relationship between principal and agent. It is fiduciary duty of agent that they should be keeping principal interest ahead of their personal interest. But when it is not happening in practical scenario, that a loss which principal is making is called as agency cost. So where this principal and agent is coming here, the management, in case of company, management and owners are separate, investors are separate, management are working as a agent on behalf of investors. Even in case of investors, there are two categories of investor, debt and equity. All decisions are taken by equity holder, whereas money is invested by both the parties, debt and equity holders. So equity holders are representing debt holders' interest also. So they are working as agents. Even in case of equity holders also, there are two categories of equity holder. One is your controlling stakeholder, second is your minority stakeholder. All decisions are almost taken by controlling stakeholder. So he is acting as an agent on behalf of that minority stakeholder. So whenever there is a breach of this duty, agent is keeping his personal interest ahead of the principal's interest. That is creating an additional cost for the company, and that cost is called as agency cost. Now, how come excessive debt is going to create indirect financial distress, which is going to create agency cost? When company is going to incur heavy, when company is using heavy excessive debt in its capital structure, what will happen? The management will always have, or the equity holder will always have one mind or thought in their, one thought will be always there in their mind, that we have to pay interest at the end of this year, at the end of this quarter, at the end of this month. And this may motivate them to go for more risky project, which the minority stakeholder or the debt holder may not like, or the overall equity holder may not like. That is where the agency cost is coming. Financial distress can create an additional agency cost. Next, conflict of interest can also be there. That I have already, and this conflict of interest is nothing but as that agency, another way of agency cost. Your debt holder are fighting with your equity holder. Your majority holder are fighting with your minority holder. Your management is fighting with your equity holder. So these are the indirect cost of financial distress when you are going to have excessive debt. So that theory with tax, which was saying that optimum capital structure is that structure where you are going to use 100% of debt and the value of firm will be maximum. They have not considered, they have actually taken an assumption that there are no bankruptcy cost, or this bankruptcy cost is nothing but else your cost of financial distress. So they have assumed that this is zero. But now, after understanding financial distress cost, we understand that as you increase debt in your capital structure, this extra cost is going to come in the picture. So what this static trade-off theory says that? Static trade-off theory says that as per if says that debt equity ratio, and this is the value of firm, as you increase your value of firm, as you increase the debt in the capital structure, your value of firm will increase. The static trade-off theory says no. Initially, when company is unlevered, VU, and this is your VL as per Initially, VU is okay. As you increase debt in the capital structure, of course, increasing debt in the capital structure with taxes, we are talking about taxes. That's why VL is going up. If without taxes, VU and VL is always same. Value of levered and unlevered are equal in case of without taxes approach. So As you increase debt in the capital structure, there is a benefit of tax shield on interest. And for a very limited debt in the capital structure, the cost of financial distress is also okay, manageable, less than the benefit what is accruing from the tax shield on interest. So of course, the value of firm is going to go up. Then as you increase more debt, still the benefit is higher than the extra financial distress cost. So still the line is sloping upward. At a point, at a level, at the optimum level, at one level, we'll say this as optimum level, at a specific level, what will happen? The benefit of tax shield on interest is exactly equals to cost of financial distress. So if it is exactly equals to cost of financial distress, there is no extra advantage for increasing the value of firm. So this blue line will reach a peak point. And beyond this peak point, if you increase your debt in the capital structure, your benefit accruing from interest, tax shield on interest, will be less than the cost of financial distress, overall present value of cost of financial distress, and this will bring down the value of firm. This will bring down the value of firm. So what is the optimum capital structure? The optimum capital structure is that level where this line, this valuation of firm by static trade-off theory is highest, and this is now the optimum capital structure. This is the optimum level of debt, and we will call it as D asterisk. So what it says, MM theory offers an initial framework for capital structure design. However, value enhancing effect of the tax shield from leverage is offset by value reducing, your value enhancing benefit, that is tax shield on interest, leverage. This is your T into D, is going to be offset by the value reducing impact of present value. Of course, this is also going to be the present value will be considered all for this also. The expected cost of financial distress or bankruptcy cost, whatever distress cost we are going to incur in the future, we will bring it back to the present value, and then we will adjust this in the value of firm by subtracting it in the value of firm formula of MM approach. So till here it was MM with the tax. As soon as you increase this, it becomes trade-off theory. You have to trade off, you have to balance benefit with the extra cost. So I hope. So what this reduction is because of? This reduction is because of that cost of financial distress. Why this is going up? This is going up because of tax shield on interest. So that is what we already have in this graph. So there is a debt, there is a D asterisk, this is unlevered. This is unlevered firm value, and unlevered firm value. Why blue line is going up? Because of tax shield on interest. But why red line is coming down? Because of the extra cost of financial distress. And at the peak level, it is the optimum level where your debt level should be in the capital structure, and this is represented as the optimum capital structure. What it says, view represent value of unlevered at low debt, at lower level of debt. The benefit is higher, so it will result in the overall benefit is higher, incremental benefit higher than the incremental cost, so you're resulting in a higher value firm. As you increase the debt, still the benefit is higher, and it is going to offset your extra cost. At the optimum level, the third stage, your marginal benefit, extra benefit of tax shield is exactly equals to your marginal cost of the financial distress. At this level, they are exactly equals. Beyond this, the cost is going to increase. Beyond this point, the marginal benefit of tax shield is less than the expected cost, marginal cost of financial distress. So here, this is going to bring your valuation down, and here is the equation which we will use in our mathematical formulas. Why it is coming down? Because of presence of because of presence of your cost of financial distress, which include your agency cost, reputational risk cost, your cost of administration and legal cost, etc. You are administrative and legal costs are your direct cost, and other are your indirect cost of financial distress. So what is the optimum level? The debt level corresponding to D asterisk, the level at which your value of firm is maximum, P, which maximizes the value of firm, is treated as the optimum capital structure. So 3 theories we have already done. Ma'am, without approach, all capital structure are optimum, or we'll say no capital structure is optimum, or because VU and VL are same, capital structure is irrelevant. With taxes, 100% debt is the optimum capital structure where the value of firm will be highest. Trade-off theory, no, you have to balance marginal benefit of tax shield versus marginal cost of financial distress. So hopefully everyone understood the static trade-off theory. Now there are certain related issues that which firms will have higher financial distress cost or which firm will have lower financial distress cost. Just from MCQ point of view, the company which is going to which can generate liquidity very easy by selling their asset to meet out their obligation if the earnings are not sufficient, will have lower financial distress cost, and the companies which are having a more specialized assets which are not easily sellable in the market, which you cannot liquidate in the market easily to generate liquidity requirements, to fulfill your liquidity requirements, those companies will have higher financial distress cost. Some companies are listed in the module, that is airlines, shipping companies are having tangible assets which are easily sellable in the secondary market to other companies, and the companies which are generally having intangibles, technology company, software company, pharma company, patents, etc. Other companies may not be interested in your patents or your technology. So there you will be going to face problem in generating liquidity at the bad times or the difficult times. So they are going to have a higher financial distress cost, just as normal things. Agency cost we have already done, but in agency cost there is one hypothesis given by free cash flow hypothesis, that is Michael Jensen's free cash flow hypothesis. What this says, this says that as you increase debt in the capital structure, your management will become more disciplined with the higher debt. Why they will become more disciplined? Because they will have less free cash flow to spend. What they are saying, somewhere they have said more debt spend, they will have less cash to spend cash unwisely. In professional world, no one is going to spend unwisely, but still they are saying as you increase the debt, there will be always a thought that we have to pay interest, so we should save, we should not spend unnecessarily. So that is the hypothesis given by Michael Jensen free cash flow hypothesis. Let's move further. So there are two more topics: target capital structure and pecking order theory. Let's continue with the numerical questions first. So numerical questions, illustration number 3. What it says? Quickly, let's go for it. Calculate value of firm, value of equity, cost of equity, WACC for the firm if it is expected to generate $1 lakh as an annual free cash flow, considering currently it has all equity capital. Currently it is unlevered. So now I am not using two company. I am changing my all equity unlevered company to a levered company. And cost of equity in case of unlevered, it is in case of unlevered situation, it is having a cost of equity of 10%. And this company is also generating my EBIT, earning before interest tax, of $1 lakh. Now what I am thinking is, firm is planning to, or company is planning to introduce debt. Now we are introducing debt. Right now it is nil. We are introducing $2 lakh debt at a cost of 7% debt by buying out the equivalent equity. So whatever amount we are going to get from debt, we will pay to equity holder, and we will reduce their share. We are not increasing assets. We are not changing the free cash flow. Otherwise the value will change, because the pie will change. The size of pie will change as per the then the value will change. So now what they are saying, they are asking us to calculate value of firm, value of cost of equity, value of equity and cost of equity, and the fourth is value of WACC also. Situation 1 with taxes, without taxes. Situation 2 with taxes. There are no there are no cost of financial distress. So let's go for situation 1. It's a repeat practice question. This we have already done in the video of MM without taxes. Tax is 0. Tax is 0, nil. So in this case, the approach says MM without tax says VU is equals to VL. But what is VU? First calculate income statement. Income statement. Step 1. U $1 lakh, L $1 lakh. Less interest, that is equals to nil. So my earning before tax or for equity holder or equity earnings, because there are no taxes, is equals to $1 lakh. This 1 lakh will come till infinite. So let's calculate the value of firm. Value of unlevered situation will be equals to 1 lakh divided by 0.10. Your cost of equity, EBIT, divided by your cost of equity is equals to ACE is equals to 10 lakh, $1 million. $1 million. So now $1 million is value of unlevered as per MM. Without tax, VU is equals to VL is also equals to now 1,000,000. Even though you are introducing debt, still the value will not change. Next, step 3, value of equity. In case of U, unlevered is equals to 1 million only, because it's 100% equity. Value of equity in case of levered, it is value of firm minus value of debt, which is equals to 1 million less, how much? I think 2 lakhs. Yes, 2 lakhs. So we got 8,000,000. Why I have not used the same formula EBIT upon KE in case of levered situation? Because we do not have KE here. The KE will not remain constant. This is not going to be constant because KE will increase in a linear relationship with your debt equity ratio. So we have to first calculate value of, always calculate income statement, calculate value of unlevered, then calculate value of levered, and then go for value of equity, then go for cost of equity for levered firm. So these are the steps for with tax as well as without tax, same thing. So now we are going to go for step number 4, cost of equity, KCE. For unlevered, it is already given 10%. KCE for levered, it's KO minus plus KO or RO minus KD. There are no taxation, debt upon equity. This formula we have already derived in the MM without tax formula, MM without tax video. 10 plus 10 minus 7%, I think the rate is 7. Yes, 7% multiplied by 2 lakhs over 8 lakh equity. So we got our cost of equity is rising 2 divided by 8 multiplied by 3 is equals to 10.75%. We got our cost of equity also here. So next, calculation step number 5, WACC. In case of unlevered, WACC is nothing but else, it is equals to KCE, which is equals to 10%. But in case of levered, it should be also 10%, because your advantage of debt will be exactly offset by increasing cost of equity. So in case of levered, it is equals to weight of debt, weight of equity, 8 lakh over 10 lakhs multiplied by 8 lakh over 1 million multiplied by 10.75, your weight equity KCE plus weight debt 2 lakhs over 1 million multiplied by 7, weight debt multiplied by your cost of debt. So what is the value? It is 10.75 into 0.8, 8.6 plus 7 into 0.2, 1.4 again is equal 10%. So graphically, if I want to plot, it's a debt, value, VU is equals to VL, this is KO, this is KD, and my cost of equity is rising at a level of 2 lakhs. Debt, my cost of debt is 7%, overall cost is 10%, my cost of equity is 10.75%, and my value of firm is 10 millions, or I think 1 million, sorry, not 1 million only, 1,000,000. So I hope without tax is done. Let's go for with taxation, the same steps. Situation 2, with tax. Again, go for income statement. Step 1, unlevered and levered situation. My earning before interest tax, that is free cash flow. I am going to get free cash flow of 1 lakh, 1 lakh, 1 lakh minus interest in case of levered. 7% into 2 lakh is 14,000. You are getting EBT, earning before tax of 1 lakh, 86,000 minus taxation at the rate, I think tax I have given how much, taxation is, where is the taxation? 25%. 25%. So subtracting 25%, 25,000, and 86 into 0.25 is equals to 21,500. We got a shield. So earning after tax is equals to 75,000. Same firm, but the returns are now lower. So value of firm will of course go down for even unlevered firm also. 500, 3,500, and how much? Minus plus 86 is equals to 64,500. Not 86 into 0.75, it's 64,500. Yeah, 64,500, correct. So now second step, step 2. First calculate value of unlevered. Value of unlevered is equals to earning after tax will be now discounted by your cost of equity, because the equity holder is going to get 75,000 now. 75 capitalized by your cost of equity, 75,000 over a cost of 10% is 750,000. So now it's not 1 million, it is less than 1 million even for unlevered also. So what is VL? It is VU plus T into D. That is equals to 750 plus 0.25 multiplied by your 2 lakhs, that is equals to 50,000. So my value of levered will be 8 lakhs. Step 3. Step 3, calculate value of equity. So value of firm in this case is 7.5 lakhs. In this case, it is now changing. It is not equal. Earlier, it is in case of they are exactly equal. Value of unlevered and value of levered are both are 1 million. So now it is different. Minus a debt. In this case 0. In this case 2 lakhs. So we got value of equity. In this case it's 750. And in this case it is 6 lakhs. Therefore, cost of equity, it's already given for unlevered, it is 10%. Cost of equity for levered, it is equals to KO for unlevered, of course, plus KO for unlevered minus, which is also equals to cost of equity, minus cost of debt, 1 minus tax, D upon E. The benefit of tax shield will reduce my slope of the line. So this is going to be 10 plus 10 minus 7, 1 minus 0.25 multiplied by debt is 2 lakhs and equity is now 6 lakhs. Overall value is equals to 3 multiplied by 0.75 multiplied by 2 divided by 6. So again it is 10.75%. The same it is coming 10.75. Earlier also it was, but the points are different. This we have already explained in the video of with text. So now we have already got KC. We can calculate step 5 WACC, but if WACC is equals to, for unlevered it is 10%. For levered it is equals to weight equity, that is 6 lakhs over 8 lakhs multiplied by 10.75. Now WACC is going to go down because of advantage of tax shield, plus 2 lakhs your weight of debt upon 8 lakhs multiplied by 7 multiplied by after tax cost 1 minus 0.25 is going to give us how much? 7 into 0.75 into 2 divided by 8, that is 1.375 first, and second is 10.75 multiplied by 6 divided by 8 plus this value is 9.375%. So WACC is going down. So if I plot on a 2-panel graph, this is my 2-panel graph. The value of unlevered is this VU value. Let's keep it on the top. Value of unlevered is this VU, and value of levered is going up. So this is VL. Now debt cost is 7%. Value of unlevered cost, overall cost, is 10%. But my KO is 10% for unlevered. But for levered, it is going down. It is going down. And at 2 lakh rupees, the value is equals to how much? 8 lakhs. This is 7.5 lakhs. 7.5 unlevered, 8 lakhs is the levered situation. 10 is the starting point, but this is going to give 9.375 my KO, and cost of equity is going to go up to 10.75%. This is my cost of equity, KCE. This is my KO unlevered, and this is my KO levered. So hopefully this we have already done. Earlier we have taken 2 different companies. Now we are changing one unlevered company to a levered situation. So same 5-6 step. I hope everyone is okay. Next, let's go for the illustration of static trade-off theory. What this static trade-off theory is going to say? Now we are going to introduce present value of cost of financial distress also. So in this case, the value of firm will be equals to VU, the unlevered value, plus T into D minus present value of cost of financial distress. First case, case 1, 2, 3, 4, 5, 6. Trade-off theory. Level 1, VU, what it says? Perpetual constant cash flow is 32 million before taxes. Value of unlevered firm in this case is 240 million. Company is replacing equity by introducing debt at the cost of 7%, cost of debt, and the tax rate is 25%. So we already have a value of levered firm. We can of course calculate cost of equity also from this calculation, because value of unlevered is equals to EBIT. There are no interest, so you have to pay taxes upon cost of equity. This same formula we have already used in this illustration as the step number 1. This is the formula EAT. What is EAT? It is EBIT 1 minus tax rate upon KCE. Because EBIT, there are no interest, so it becomes EBT into tax rate. So that will give you tax minus doing taxation, subtracting minus taxation from EBT, it is going to give EAT. So what is EAT? It is EBT 1 minus T, and EBT itself in the case of unlevered is EBIT. So directly formula is EBIT 1 minus T upon KC. So using this formula, you can calculate cost of equity for unlevered firm, but for levered firm, this is going to increase. We are not going for that. So let's do the cost of equity calculation at least. 32, 1 minus 0.25. This is going to give KC. What is cost of equity for unlevered firm is equals to 32 into 0.75 divided by 240% is equals to 10% is your cost of equity. Next, so let's go for the MM. First, value of levered firm is, this is MM with taxes. So in this case, it is 240 plus 10 multiplied by 0.25 will give you 240 plus 2.5, that is 242.50. Second case, but in case of trade-off theory, what you have to do? In case of VL is value of firm will be equals to 240 plus 10 multiplied by 0.25 minus the cost is already given on the present value terms minus 0.1, that way is going to be 242.40. So it is going a bit lower because of that extra cost. Next, second level, value of firm. Value of firm. Now in this case again 240 plus how much? 20 into 0.25. 20 into 0.25 is 5. That is equals to 240 plus 5 is going to increase my value to 245. As you are increasing debt, your valuation is increasing. Here in this case, value of firm will be 240 plus 20 into 0.25, but you have to subtract 0.5 minus 0.5. So 244.50, still increasing, but at a lower pace. Third case, value of firm 240 plus 30 million into 0.25. So 240 plus 7.5 is equals to 247.5, still increasing. Here value of firm 240 plus 30 into 0.25. Now my equity holder are feeling heat, so they are going to increase their expectation. So or it is going to create financial distress in the company, not expectation, financial distress, and this financial distress cost is reaching to 2 million now. But still the advantage is more. 7.5 minus 2 is equals to 255.50. Still it is going up. Fourth case, value of firm is equals to 240 plus 40 into 0.25. 240 plus 10, 250, going up. Value of firm 240 plus 40 into 0.25 minus more financial distress, because now you are going to commit more interest, 4 millions minus 4, that is 240 plus 10 minus 4, 246, not 246, how much? 240 plus 10, 46, oh why, yeah, 246, somewhere I have done 240, this is wrong, 245.5, not 255, sorry. Next is level 5, value of firm 240 plus 50 into 0.25, the tax rate. Tax rate is 0.25, is 0.25. So this is going to give 240 plus 12.5, 252.5, going up. Value of firm 240, 50 into 0.25. But now more financial distress, it is going to increase cost to 12.5 minus 12.5, 240 plus 12.5 minus 12.5 is equals to 240. The overall valuation decrease from 246 to 240. Decrease. It's not that the total advantage is equals to total cost of financial distress. It's the marginal. So here the extra advantage is only point plus 2.5. But extra cost you are incurring is from 4, it is reaching to 12.5. So extra cost is 8.5. So this is not optimum point. This is not optimum point. The overall advantage is equals to overall cost. But the marginal advantage is only 2.5. From 10, it is increasing to 12.5. That means 2.5. and from 4 million cost, it is increasing to 12.5 million. So it means your marginal cost is 8.5. What we want to equate marginal benefit with marginal cost, not the total cost with the total benefit. So what is the optimum point? So from here onwards, your valuation is going to go down 6.240 plus 60 into 0.25 is going to give 240 plus 15 is equals to 255. Is increasing the value as you increase the debt. But this is value of firm 240 plus 60 into 0.25 minus, what is the financial distress cost in this case? 16 minus 16. So 240 plus 15 minus 16. It is in fact now decreasing the overall valuation from the unlevered situation. So excessive debt is going to be dangerous for the company as per trade-off theory. This may bring down the valuation. What is the optimum point? This is your optimum point where your marginal benefit is still higher than your marginal cost. What is the optimum point as per trade-off theory? As per trade-off theory, not for all. This is the optimum point. The fourth situation is the optimum point from the static trade-off theory. So hopefully we have done Now trade-off theory is also over. Cost of financial distress is also over. Agency cost is also over. Now only two small topics. First, let's go for one more small illustration, calculating the weight of debt and weight of equity in case of WACC calculation. If debt equity ratio is given as 3 times, and sometimes they give debt equity ratio as 3:7 times. First case, if your debt equity is equals to 3 times, it means 3:1. This represent your debt, this represent your equity. If you add it, your value of firm is equals to 4. So weight of debt is equals to 3 over 4, 0.75. Weight of equity is 1 over 4, that is 1.25. B situation, debt equity ratio is 3:7. This represent your debt, this represent your equity. If you add it, your value is 10. Overall value of firm is 10. So weight of debt is 3 over 10. It's 0.3. And weight of equity is 7 over 10. It's 0.7. So we have to use debt equity ratio very carefully when we are doing calculation of WACC. Next, one more illustration related to target capital structure. But before that, let's go for the theory part. Two small theory topics. What is target capital structure? So now what is target capital structure? It's now again in continuation with your static trade-off theory. Static trade-off theory, we have arrived at a optimum capital structure where your marginal benefit beyond at optimum point, marginal benefit of tax are either equal or higher, and beyond this the marginal benefit will be less than the cost. So in our example it was 4th level. But how to actually identify this D asterisk? Is it very easy to calculate financial distress cost? No. So generally what happen, management rather than going for a specific D asterisk optimum point of debt, they generally give a range of target debt equity ratio which covers that D asterisk. What it says, optimum point D asterisk of debt equity cannot be precisely estimated because that present value of cost of financial distress is very difficult to calculate. Hence, manager established target capital structure as a optimum capital range in which that D asterisk will be also there. But sometimes there are 2-3 small MCQ related topic. Why your target capital structure is different from actual capital structure? Why? Because of various reasons. Number one, because of your financial reasons also, as well as reasons which are coming from the market side also. So why? Management may exploit sometimes short-term opportunities. What type of short-term opportunities? Sometimes because of reduction in your central bank rates, debt is available at a very cheaper rate. to exploit that opportunity, management may go for raising finance from debt more than what is already what is there in the target capital structure. So management may exploit short-term opportunities in particular financing source. If debt is available at an attractive term, company may borrow more than the planned or the target rate. Second, changing market value of debt equity itself is also going to impact my overall value, weightage of debt and equity in the capital structure. So always having a fixed capital structure weight is not possible, because the value of equity is changing as per the demand and supply forces in the market. So that is also creating a deviation from that target range what management has want to achieve. Next, transaction cost and sometimes minimum deal size. Your debt holder will say that no, we will go for at least 500 crore rupees of debt only. We will not go below this level. Or equity holder may ask to raise the equity finance. So because of these things also, sometimes you have to raise higher or lower amount of debt or equity to minimize the transaction cost or to satisfy the minimum deal size requirements. So that is why your target capital structure may differ from your actual capital structure may differ from your target capital structure. Next, many times target capital structure is also presented in book value terms. We know that PAC should be calculated using market value weights, not book value weights. But target capital structure weights are sometimes expressed in book value terms. Number one, why? Market value itself is fluctuating, and something which is fluctuating, it is very difficult to fix a value for that thing. Second, for management, the primary concern is the amount and type of capital invested by the company. How much company is investing in a particular asset? They want to earn return on that asset, which is the value which is available with them. The X company is having a book value of 250 rupees, but market price may be 2000 rupees. Company has nothing to do with that 2000 rupees, because that 2000 rupees is not coming to company. That is the value being exchanged between investor A and investor B, seller and the buyer. Company is not getting that 2000 rupees. For company, the value is what is there in their balance sheet. So it is better to go for a capital structure in book value terms, which is the actual amount available with the company. And sometimes capital structure is aligned to measures used by third parties. Who are these third parties? Your financiers. What financiers are going to do? They are going to calculate their solvency ratios, leverage ratios based on your balance sheet and P&L, not the actual market prices. So debt equity ratio or your other coverage ratio, interest coverage ratios, etc. They are actually based on the values in the books. So that is why the target capital structure sometimes is expressed in book value terms. Next, identifying, how to identify what is the target capital structure company is using. First, use the market value of the current capital structure, use the equity data from the balance sheet, multiply it with market price, use the data of debt from the balance sheet, multiply it with the market price if it is trading in the market, and this is your target capital structure, which as an investor or an analyst, I can assume that what management wants to keep for them, and what they want it as, they think it is the best, or their that structure is the target capital structure for them. Second, what you can also go for is the comparable companies capital structure data if it is available, and generally the industry average is used. Generally industry average data is used as the target capital structure. So if there are 10 companies and X is one of the 10 companies, it is generally assume that the whatever the capital structure of those 9 companies, on an average, even the X company will also wants to have that same capital structure on an average basis. We have a mathematical numerical question for this. We will do it at the last. And examine. Sometimes we have to also examine or the trends and the statement what management is giving in their commentary, and that will also give us an idea about the target capital structure. So normal theory. Next, the last theory, pecking order theory. Without X says no capital structure is relevant because no capital structure is optimum, or all capital structure are actually optimum because there is no impact on the value of firm. With X says increase the debt, highest debt will have is the best capital structure. And trade-off theory says consider present value of cost of financial distress, and at the peak of the value, where the value of firm is at the peak, that is the optimum capital structure. Fourth theory, packing order theory. What this theory? A different thought process, very different thought process. It says that management, the people who are in the control of the company, they want to share least information with the outsiders. Because if they share information with the outsiders are going to ask questions or put restrictions if they have control, if they can. So management wants to, management prefer to share least information to outsiders. So there is always a asymmetric information between the management and the outsiders. Management give first preference. What this pecking order theory says that we will prefer to get the finance from the source which will have least potential information content. By using that financial source, least information will be released to public. That will be the first source which we are going to use. So there are three sources, in fact 4 sources. First is your internal accruals, earned and retained by the company, your debt which you are raising from private sources, debt you are raising from public sources, and equity which you are raising from, of course, public. Where the information will go lowest in the public, of course, the internal accrual. If you are using your internal accrual, the income are generated by company itself, you have to answer no one. You have to share no information with your debt holder or other investor or public or equity holder. The management will try to use internal accrual first. So there is no debt equity, capital structure, optimum capital structure. It's the preference, order, rank based on the information flow. Least information flow should be there. So least information flow to public is with the internal accrual. So no capital structure is optimum. It is the first use we will be using internal accrual. Next, then we will use debt on a private mode basis. Privately, we will issue debt to less number of people so that we need not to disclose information to the public. If now that is over, then we will go for public debt. Still less information is required. And at last, if no source is giving us fund, then we will go for issuing the equity, where the maximum information you have to share with the public. This is the pecking order theory, or the summary of the pecking order theory. The reasoning is we want to share lowest information. We want to share least information to the public. And the last preference is where there is a potential information content, most potential information content, that if you are issuing equity, it is going to give the highest information, maximum information to the general public. Issuer and investors have asymmetric information, those who are in control and those who are investing in the company. Issuer management has access to more information. Of course, they are insiders. Thus, investor often closely watch what managers' behavior for insight into the company's prospects. Generally, people do watch that what management is saying, what management is doing, what actions they are taking. So if these are called signaling effects, what they are actually signaling to the market overall. If company is issuing equity, it means first, no cheaper source is now available to company for raising the finance. Number 2, either the share or the share prices are overpriced. That's why company is selling the shares. Or third, company is not confident to pay its obligation of interest in the future. So this is a negative sentiment. Here is overpriced, negative sentiment. Company is not confident of generating future income to pay a fixed commitment of interest. That's also a negative sentiment, negative signal. If company is issuing debt, it's a positive sentiment. It means cheaper sources available to it. Number 1, no need to go for higher cost equity. Number 2, company is confident that in future it will be able to generate future earnings to pay off their debt obligations or interest obligations. So these are signaling effect, and public do watch what management is saying, what management is doing with their capital structure. Ultimately, pecking order theory says that management will try to share least information. So their order will be, their order of issue or financing is internal accruals, debt private issue, debt public issue, and last is your equity issue. So ultimately, there are no optimum capital structure, and firm capital structure reflect only what has happened in the past, historic need for their external financing. At last, the last illustration. calculation of target capital structure, target weights. The company is having an existing capital structure where market value of debt is 20 million, market value of equity is 30 million. If you use market value, weight of debt is 20 over 50.4 and weight of equity is 30 over 50, that is 0.6. The data of competitors, which we can use to find out the target capital structure of the management in the industry, is as follows. The market values are as follows. So total value is 180 of ABC. The second this is XYZ. These are competitor number 1, 2 and 3. The total value is 80. Total value is 110. So let's calculate the value of weight of debt. In this case, it's 80 over 180. 80 over 180. It's equals to 0.444. 30 over 80. 0.375. And last, 40 over 110. 0.3636. What is the target capital structure? Of course, the average of that. So weight of debt, target weight of debt should be equals to 0.444 plus 0.375 plus 0.3636. We are assuming that these three competitors are immediate competitor of our XYZ. Their risk factors are exactly equals to our firm in question. So it is plus 0.375 plus 0.4444 is divided by 3. So our target weight is 0.3943 and our company's weightage is by chance is almost equals to the target weightage. By chance, may not this may not be true. Next, of course this will be 1 minus this value, but let's check it out. Divide by 180, 0.5556. 50 by 80, 0.625. 70 by 110, 0.6364. You can average it, 0.5556, 0.625 and 0.6364 upon 3. Let's check it out. What is the value? Plus 0.625 plus 0.5556 divided by 3 is equals to, of course, 0.6057 and total should be 1. These are our target capital structure. So here we are done with all the theories, questions of target capital structure and packing order theory, financial distress cost, agency cost. Many things I have covered here, and the last and most important, the trade-off theory, that present value of financial distress cost, how it is going to impact the valuation of firm and what is the overall best optimum capital structure. So hopefully everyone understood it. Thank you so much. Thank you.